Happy holidays from the Keen Wealth Financial Planning Team.
Merry Christmas and Happy Hanukkah from our family to yours.
Happy holidays from the Keen Wealth Client Service Team.
Merry Christmas!
Merry Christmas!
Happy holidays from the Keen Wealth Planning Team.
Merry Christmas and Happy Holidays.
Happy holidays from the Keen Wealth Marketing and Compliance Team.
Merry Christmas, Happy Hanukkah, and Happy Holidays. Wait!
Happy holidays from the Keen Wealth Leadership Team.
Here's to a peaceful and prosperous 2024. Happy holidays from the Keen family.
Hello everyone, Bill Keen here. As we are firmly in the middle of another holiday season, the team and I at Keen Wealth Advisors want to first say thank you. Thank you for allowing us to walk alongside you and to serve as your financial advisor. We take that responsibility very seriously as we help you navigate the many technical and personal financial decisions that you are faced with in the ongoing planning process. There is nothing more fulfilling to us than to see our clients, each at varying stages of their journeys, being great stewards of their resources while living out their best lives with clarity and confidence. As this year comes to a close, I also want to thank the incredibly talented team at Keen Wealth Advisors who are dedicated to your success each and every day. I could not be more proud of the culture of our firm and the character and professionalism of each and every one of our team members. Many of you were able to join us at our recent holiday celebration at our beautiful headquarters here at the Light and Tower. We once again enjoyed great food, a wonderful live harpist, and multiple activities for the children, such as cookie decorating, letters to Santa, letters to veterans, and other holiday arts and crafts. We even had Santa himself on site to round out the event. An important aspect to our firm and the events that we host is providing a space for community and fellowship for all ages and family members. From the feedback we have received, I believe we hit the mark. And while I did see many children meeting with Santa, I also will report that just as many adults spent time and received photos with Santa as well. Word has it that some of the adults asked Santa for a strong market and low inflation in the coming year. Rest assured, we will be holding this event again in 2024 and hope to see you and your family there. Also, we are excited to announce that our family-friendly summer barbecue bash will be held again this late spring, so be on the lookout for the details and mark your calendars accordingly. We again will have many activities for the children, so round them up and bring them out, along with any friends or colleagues you would like to introduce to the firm. We greatly enjoy the time we get to spend with each of you at these events, and will continue to provide the opportunity for these experiences that are quite unique from other financial advisory firms. We call it the Keen Wealth Community, and we are grateful that you are a part of that community and our family. And finally, I want to report, this past year, the Keen Wealth team did some amazing work in our local community. In addition to the firm making substantial financial grants to multiple charitable organizations, our team spent time working on site at places like Veterans Community Project, Angel Flight Central, Kansas City Girls Preparatory Academy, Harvesters, and many more. Again, I could not be more proud of the team and their dedication to making a difference in the lives of those less fortunate. Now for our next speaker, the President and CIO of Keen Wealth Advisors, Matt Wilson. I've had the privilege of working alongside Matt for nearly 22 years now, and I must say his steady hand, calm and measured approach, and his data-driven analysis is a hallmark of our work. Matt today will be providing you with his 2024 market outlook that I am certain you will find helpful and enlightening. On behalf of myself, my wife Carissa, and all of the caring and talented professionals at Keen Wealth Advisors, we wish you a joyous and blessed holiday season and a happy, healthy, and prosperous 2024. Matt, take it away, sir.
Well, thank you, Bill. Well, 2023 has been an interesting year, to say the least, and I am very excited to share with you our recap of what happened this year and our outlook for 2024. Definitely a lot of things going on and a lot of things that we will continue to talk about throughout the following year. And we have the upcoming election and no shortage of commentary from a geopolitical standpoint, and also the Federal Reserve and what they're doing with interest rates. So again, looking forward to sharing with you our outlook for 2024. And with that said, let's get right into it. As I mentioned, 2023 was an interesting year. And so far, we are looking to finish on a very strong note. And one of the big things around that is the market is reflecting what's going on in the economy and the fact that individuals and investors, institutions, they overreacted last year to what was going on in the interest rate market. Definitely a lot of fear of a upcoming recession, and it just did not pan out. And the data, continued to confirm that throughout this year, and the market is reacting positively. Oh, here's performance of major indices that we track. Top performer this year is the NASDAQ, which is made up of 100 companies that trade on the NASDAQ, majority of them being tech stocks. And then we have the S&P 500, which has a big weighting to technology, so it's being reflected in that. The international markets are off to a strong year, finish to the year for sure. Dow Jones performing well, small caps, and even emerging market stocks. Now, not all things are created equal. We look at these major indices to give us a general idea of what's going on in the market. And that doesn't, though, give us a broad measure of what's happening. So here I have the S&P 500. It's the red line on this screen. And it's up almost 23% for the year through the end of the day on December 15th. Then we have the RSP, which is an equal weighted version of the S&P 500. So the way the S&P is put together is that it's what's called market cap weighted. So the bigger a company is, the larger percentage weight that it has within the index. And so the largest companies generally get more of a weighting, and as they grow, their weighting increases. That, though, comes at the expense of some of the smaller companies. And the equal weighted index just looks at all of the companies in the S&P 500 and weights them exactly the same. And when you do that, you can see the RSP, or the equal weighted index, is up just over 12% for the year. So yes, what that tells us is that there's a small number of stocks that are generating majority of the gains for this year. And we look at that because we do want to have a broad-based and diversified portfolio, and we want to understand what's driving returns throughout the year. Now, what I did here was I just took market returns since October 26th, 2023. Not that long ago. And the reason I picked that date is that's basically when the market stopped going down. We had a pullback that started in August, moved into December and October. And, there was a period there where it seemed like the market was just going to continue to go down. And we got a lot of, questions and concerns from folks as, as they were paying attention to my market webinars and also as they were coming in for reviews about what's going on with the market. Well, again, our view was that market was overreacting to what was happening in the interest rate markets. And since then, markets have turned around, interest rates have come down a little bit, and we're seeing that reflected here in stock prices in a very quick turnaround too. And the reason I'm showing this is because markets will move very quickly, and there isn't a way on a short-term basis to figure out when to get in and when to get out. I mean, we're looking at a period here of right around 6 weeks, end of October through middle of December. And you're looking at returns that anyone would be happy with for an entire year, maybe even 2 years. And we're seeing small caps up 20%, NASDAQ up 18% almost, S&P up 14, Dow up almost 14, international markets up between 9 and 12%. And again, that's in a 6-week period. Market returns can come very quickly and very sharply before anyone can really react to it. I mean, we even saw a week there where the market was up over 5% in just 1 week. Now let's take a farther view. Let's take a step back and look back to 2022 and beginning of that year, January of 2022, because we've had a 2-year period where returns are essentially flat. I mean, that's what this graph shows. We can see the Dow is actually up the most, up over 12.6%. So I point that out because people look at and they see the NASDAQ up 51% this year and think, wow, that's great. And what they don't forget though was that, or what they don't realize was that the NASDAQ was down over 30% last year. And while the Dow is only up, 14, 15% this year, it was not down nearly as much last year. So it didn't have to return as much to get back to even. And actually over the last 2 years, the Dow is the best performing index between all of them that we track on this chart. So, protecting the downside is extremely important and something that we pay very close attention to. Now let's look here at the different sectors that make up the market. Technology, that's going to follow the NASDAQ very closely. Communication stock, which some people kind of think of them as technology companies. That's typically your social media companies like Facebook, which have performed well this year. Consumer discretionary, that's what people have excess funds. What are they spending money on? Followed by industrials, materials, real estate, financials, all performing well this year. And then, we've got some laggards: healthcare, energy, consumer staples. Consumer staples are considered a very defensive sector. It's what people spend their money on. No matter what, when you go shopping at the grocery store, that's considered consumer staples. And utilities as well, controlled monopolies. Here I've got interest rates and yields. So this is the interest that these government bonds pay. These are US government bonds. So we have the 2-year Treasury paying 4.4%, followed by the 10-year Treasury just barely paying more than the 5-year Treasury, but they're both basically at 3.9%. And they peaked in late October. And we're seeing the rally kind of as markets realize that interest rates had kind of overreacted. Markets overreacted as well. Equities went down, stocks went down. And then finally, that trend changed, and we're seeing a positive reaction here in the stock market as interest rates have kind of come back down. This is fixed income performance going back to the beginning of the year. And you can see there's volatility in owning bonds. And these are government bonds too. So while you'll get your principal returned to you, bonds trade. So you're getting a price every day that the bond market's open around the value of your bond. And if you wanted to sell that bond prior to maturity, what would you receive? And that's what these squiggly lines represent, is the value throughout the year based on these different types of government bonds. The orange and light blue, those are longer term bonds. So they have a lot of volatility tied to interest rates, because as interest rates move, your existing bonds, if you have a long-term bond, go up and down relative to what existing interest rates are. Then we have shorter bonds in the purple and green, what we consider kind of intermediate term bonds, and then short-term bonds in the dark blue and the red. Much less volatility around those because those bonds mature constantly and you're able to reinvest them at higher rates. So they have less interest rate risk, as as we say in the industry. Now you can see, look at these long-term bonds from the end of October down anywhere from 10 to 15%, and now up between almost 3 and 4% over that 6-week period. So a lot of volatility in long-term bonds specifically. Now, what's driving all this? Well, let's talk about the economy. I like to share these charts on a regular basis, provide context as to what we're looking at, what the economy is doing, without all of the opinion that people place on them, especially in the financial media. The financial media can spin a lot of things and focus on something that's very minute in the grand scheme of things and make it sound really bad. So let's look at the big picture. Jobs are extremely important here in the United States. Our GDP, it's the value of everything that we produce on an annual basis. We're north of $20 trillion. It's a massive economy. And 70% of GDP is driven by consumption. It is what individuals, you and me, what we decide to spend our money on. And when we have jobs, we have more money to spend. And when we spend money, that shows up as revenue for businesses. And stocks are, they're shares of businesses. And stock prices are a function of earnings. So when you have revenue that flows through the accounting statements and shows up as earnings, after all the bills are paid and all taxes and everything else. So if we have an idea of what's happening in the jobs market, we can generally, all right, let's see, how is the economy going to do well? Is it going to perform poorly? Is it going to perform great? Is it going to just be kind of sideways based on what's happening here in the job market? Well, we've been on a very steady increase in jobs here over the last several years. I mean, we spiked back past the high pre-COVID, 152 million jobs prior to the COVID crisis, and now we're at 157 million jobs here in the United States. And employers are still looking for employees. Now that number has been coming down, and this is something that the Federal Reserve has been hinting at, is that for them to feel comfortable about reducing rates, I mean, they've been paused now for several meetings, but for them to feel comfortable that inflation's under control, they would need to see some weakness in the jobs market. Now, what they don't want to collapse the jobs market. They're not looking to just have a bunch of layoffs, because that would create a lot of weakness. What they're looking for is the jobs market to be less tight. So a tight labor supply is when you have a lot of demand for workers, but not a lot of supply of workers. And we've had that last couple of years. A lot of companies are looking to hire, and there's just not enough applicants applying for those jobs. We've had record job openings, but that's easing. Still job openings, because we still have positive hiring here in the United States. We just have less job openings. So that tightness is starting to ease in the job market. Now, continued claims. This is when folks first get laid off, and we're looking here to just gives us an idea of what's going on in the job market. If we see spikes in unemployment, and specifically these initial claims and continued claims, what that does is that tells us that, all right, there's more and more people getting laid off. Well, continued claims has been fairly steady. I mean, it's been trending ever so slightly, but you can kind of see this line does ebb and flow just slightly. And, we're right basically in the same spot where we were pre-COVID. And the reason I point that out is because it just kind of shows, all right, pre-COVID, post-COVID, yes, we had the big spike but we've had it steadily coming down. So these are people on long-term unemployment here in the United States. Now, retail sales continuing to increase, a good sign. Housing, housing has been actually very steady, building a new base. You almost look at this trend line coming out of 2008, 2009. Housing collapsed significantly, and we still haven't got to the peak prior to the basically 06 when housing peaked. We've been on this trend. We've had some spikes there kind of post-COVID, back kind of on trend again. And that's with higher interest rates. So there was a lot of talk about housing collapsing during those interest rate increases. And yeah, it came down, but it didn't collapse. And specifically, certain markets aren't nearly as in high demand as they were, especially areas that are typically second homes for people. But housing has been very stable, and there's still a shortage of supply just across the country. Not enough housing is available, and specifically, housing that is for first-time homeowners. This is business spending. Business spending has been fairly flat. I mean, it's still at a high level, it's not coming down, but it's been sideways. Nothing inherently wrong with that. You can see periods from 2012 through 2019 where business spending was flat, actually even trended down there for a little bit. Businesses, what they spend their funds on does contribute to GDP, not nearly as much as consumption, but it does contribute, so we do track that. And then here I've got interest rates, and specifically the yield curve. So this is the 10-year government bond minus the 3-month government bill. They actually call that a bill instead of a bond. And this inversion, I've shared this chart many times. This gets a lot of media coverage, but basically you see inverted yield curves, basically when short-term rates are higher than long-term rates. I showed that chart early on. The 2-year treasury is at 4.4%. The 5 and 10-year is at 3.9. So short-term rates are higher than long-term rates. And this, from a financial perspective, basically what that means when we have an inverted yield curve is that the cost of capital is getting more expensive, and businesses, their financing and capital management needs are, they're getting tighter, not nearly as favorable as they were prior to the yield curve inversion. And you can see yield curves have inverted prior to recessions. And all these charts that I've been showing and will continue to show, anywhere that shows these gray bars, those are recessions. Even pre-COVID, the yield curve inverted. Now, I wouldn't go as far as saying that the yield curve inversion here predicted COVID. But we are in a situation where the yield curve is inverted. Now it started to come back. Now it's going back down again because interest rates have been, moving here over the last 6 weeks. Now, one thing that is different this time is that the Federal Reserve, basically since 2008, 2009, has been very active in the government bond market. In their attempt to keep interest rates low, they have used a lot of different things at their disposal. It's all part of what they can do to keep interest rates low. And that was the quantitative easing that was talked about, where they're going out in the open market and they're buying bonds, creating demand, which is lowering interest rates. Now they've been in this period of quantitative tightening where they're not buying those bonds anymore and they're actually letting them mature, which is allowing interest rates to come back up. So that process is creating, I think, some of this inversion, which is different than investors determining where the yield curve should be, which is what happened in these previous three. So while we pay close attention to it, I do think there is slightly different circumstances this time that aren't going to suggest that this is going to lead to a massive recession that's going to start here any minute. Now let's talk about corporate earnings. Corporate earnings, stock prices are a function of earnings. And here's where earnings estimates are for the S&P 500 for 2023, basically looking at $220 a share. We'll know more about where earnings come in once the earnings season starts in Q1 of 2024. And then earnings throughout 2024 estimated to be $245. And then in 2025, $275. And I show these because these earnings estimates are what's used in our market multiple calculation. And as we go through 2024, the market's going to start pricing in expectations for 2025. So let's look at the market multiple. I know this is a favorite chart for a lot of folks. They like to kind of hear the range of scenarios that we could see over the next 12 months. So here's how the math works. So we have our earnings estimate of $275 for 2025 earnings. And the reason we use that is because at the end of 2024, the market should be trading at expectations for 2025. Right now, the S&P, or as of the close of business on December 15th, the S&P 500 was just over 4,700. And now if we apply a multiple to this earnings estimate, we get the ranges here. So 18 times 275, that gives us 4,750. 20 times gives us 5,500, and 22 times gives us 6,050. So those are price targets for the S&P 500. Well, right now, the multiple is about 21.5. So between, on the high side here, if everything goes great and earnings estimates continue to improve, even higher than what they are currently, and if interest rates continue to come down, yes, the market will probably price in at 22 times earnings to give us 6,000 plus on the S&P 500. And on the opposite side, if interest rates don't come down, if the Fed doesn't cut rates, just leave them steady, and if earnings expectations actually come down a little bit, then the market could go sideways in 2024. And then in this mid-range here, it's kind of pricing in a few interest rate cuts, earnings estimates fairly steady, don't change much, still a very good return for the year. That gives us a range of just over 0.5%, 0.66, to 28% by year end 2024 from where we are today, or as of close of business on December 15th for the S&P 500. And I use this same formula every time I put these presentations together. And a year ago, when we provided our earnings outlook and our market multiple, we came in very close. And it's not because we have a crystal ball, it's because we just use data and we use math to provide our estimates, and the market's reflecting that. I think it's just important to take the emotion out of it and just let's just look at the numbers. And it doesn't come in a straight line. You know, that was one of the important things I wanted to express in those early charts, was that there's a big piece of this year's return that just came in the last 6 weeks. And that's how markets, that's how they perform. They don't just go up slightly every single day and give us the return by the end of the year. Some years the return comes early on in the year and then it goes sideways for the rest of the year. Other years like this year, it's kind of been good in the beginning of the year, came back down, went up, came back down. Now we're closing out strong. Interest rates are going to be a key component for this market multiple and what's going to happen in 2024. Rates currently at 5.25. Actually, it's a range, 5.25 to 5.5%. And this is the rate that the Fed, the Federal Reserve controls, the overnight lending rate. And banks use this to kind of price money market funds and CDs and everything else. All the other interest rates, the 2-year Treasury, the 3-month T-bill, the 5-year Treasury, the 10-year Treasury, those are all set by the market. The government auctions off Treasuries, and that auction creates the yield. So if there's a lot of demand, yields come down. If there's less demand, yields go up, because that's how they're using it to entice people to buy those bonds. There's a lot of institutions that have a mandate that they have to buy those bonds. So it's not like, there's a massive swing in those yields, but that's how they price. Expectations for interest rates by year-end 2024 are 3.5% on the low end to 4.25% on the high end. So market participants are expecting the Federal Reserve to cut rates next year. And this is fairly consistent with what Jerome Powell and the rest of the Federal Reserve has been saying, but they haven't been indicating that they expect rates to fall as much as what the market is expecting. We'll continue to keep everyone informed about these expectations and what's going to happen as we go throughout 2024 and our future webinars. I got a lot of questions around owning stocks versus owning bonds. And specifically, when interest rates are higher, should we have more exposure to bonds? And bonds definitely play a important component within our portfolios. When we're working with folks and we're putting together a plan for someone to retire and we're looking at making distributions, well, we want to have a certain number of years that of their income needs not subject to the volatility of the stock market, and even not in long-term bonds either, because long-term bonds, as I showed, can be volatile. We want to have them in short-term bonds. And that number for a lot of folks is at least 5 years, if not longer. It's different for everybody. But we like to have that set aside when people are taking distributions, because that allows the stock portion of the portfolio to continue to grow and compound. We know it's going to go through a recession, it's going to go through pullbacks, and we don't want to be forced to sell something at a bad time. So we use bonds, fixed income, money market to structure allocations so that we don't have to sell something at a bad time. And the same is true for someone who's saving for something, whether it's a down payment for a house or it's a tax payment that you might have coming up. We don't want to subject that to the volatility of the stock market, because by the time you need it, it could be worth less than what you initially deposited. I mean, just think of this situation. You might have deposited money at the beginning of the year thinking, oh, I'm going to need it at the end of the year, put it in the stock market and needed it back in October. Market's up for the year currently, but your timing was not ideal. So again, that's what we use bonds and fixed income for. So what I did is I just wanted to show some historical perspective on stocks versus bonds and what the purpose is for each. You know, I talk a lot about what's going on currently and what's happening in the economy, help provide some perspective to why the market's doing what it's doing and what our outlook is, which is important in the day-to-day, what's happening, and you know, our take on it. But we also need to take a step back from time to time and kind of look at, well, why do we own stocks? And why do we own bonds, and what their purpose is? Well, here's what I did. So I went back to 1976 and I looked at the S&P 500, which is a basket of stocks, and I looked at the 10-year US Treasury. And I compared, if you invested $10,000 in each, beginning of the year, January 1, 1976, how much income would you have received either through dividends from the S&P from stocks, because stocks pay dividends, and how much income would you have received from bonds? Well, interest rates were higher back then, and dividend yields were actually a little bit higher. So if you invested $10,000 in the S&P 500 in 1976, at the end of the year, you would have received just over $468 in dividends. If you purchased a 10-year US Treasury, so no risk, you know, you receive your interest payments every single year for the next 10 years. And then at the end of that 10-year period, you receive your principal back. You would have received $687 in interest income. Now, over time, we know dividends change. We know interest rates change. So what I did was I looked at the end of 2022. How much income would you have received from dividends on that same $10,000 investment that you made in January 1, 1976 in the S&P 500? And if you were to continue to just roll these 10-year government bonds as they matured, how much interest income would you have received? The interest income or the dividend income on the S&P 500 on that initial $10,000 investment would have grown to just over $7,500. And it's because dividends increase over time. Historically, that's what they've done. While interest rates, you know, they're constantly changing based on what's happening in the economy, you know, what the government needs to do with interest rates. So at the end of 2022, you could have purchased a 10-year US Treasury and received that same $10,000, received $388 in interest. You know, I showed the graph earlier. I mean, it went up over 5% at one point during this year. So you could have, you know, if you picked the timing just right, currently at 3.9, so very similar to what it was at the beginning of this year, end of last year. And also, it's helpful to look at what your investment would have grown to. So the shares you were able to purchase with this $10,000 would be worth $523,000. And your US Treasury bond, you just get your principal back. You hold them to maturity. So you invested $10,000, you would have received income every year, got your principal back, reinvested. So it's important to understand why we own these certain things. Yes, there's a lot of stability in bonds. And when interest rates go up, we definitely get more questions around that. Well, should we have more in bonds? But if we're looking at a 30-year time horizon for someone's retirement, sometimes it's even longer than that. We've got to have a portion in stocks. And for a lot of folks, that's a fairly significant portion in stocks, because we want to increase your income over time. And the best way to do that is actually through dividends. Here's how dividends have grown since 1976 on the S&P 500. So the dividend income here is represented by the orange bar. You can see how that's increased almost every year. Not every year, but almost every year. Sometimes dividends get cut. And let's look at your income that you could have received on a 10-year government treasury. Now, what this is actual beginning of the year, what the interest rate was on the 10-year treasury. So just give you an idea of what that would be. You can see there was periods there where interest income was fairly high. And then we've been on a steady decline in interest rates. We've been going up here slightly over the last couple of years, especially relative to where they've been over the last decade. But historically, interest rates are still very low. So what I did here was I looked at the growth rate of the dividend since 1976 and the growth rate of the bond, of the interest that you would have received. So just your dividends grew at over 6% on a compounded basis since 1976, and your bond yields actually went down. So the income that you're receiving has the best way of it, the income that you're receiving has the best ability to outpace inflation by utilizing dividends. And then when you just factor in your initial investment, and this is not with reinvesting any of the dividends or any of the income, you would have made 8.7% on your initial investment on a compounded basis, where you just receive your principal back. You make zero. There's no capital appreciation in bonds when you hold them to maturity. Now, if you're looking to sell them, yes, there can be capital appreciation when interest rates, if you buy them at a high rate, they go down, interest rates come down, you can sell those bonds and have a capital gain. But that's not, trading bonds isn't necessarily the objective. It's about return of principal. Now, I got a lot of folks who have been to the office. They were at our office just recently, as Bill mentioned, at our holiday open house. And folks that came into my office, they might have seen my large hat that says Dow 100,000. And I don't wear this normally, but I figured, hey, it might be kind of fun to put this on for today's presentation. And specifically, I want to talk about Dow 100,000. And why do I have this hat? Well, Dow 100,000 is a possibility in the very short term. Now, when I say that to folks, they're like, no way, I won't see that in my lifetime. That's the response I typically get, because the number is just so big. It just doesn't, it doesn't compute sometimes when you think about it. And what I want to do, again, in putting things in historical context, is provide some history about where the Dow has been, and then where will it be in the future based on returns that we could see. So here we have major milestones for the Dow. The Dow first crossed through 1,000, November 14th, 1972. And then it crossed through 5,000, November 21st, 1995, 10,000, March 29th, 1999. 20,000, January 25th, 2017. 30,000, 11/24/2020. Now just think about that. The Dow just crossed through 30,000, 11/24/2020. And just crossed through 37,000, 12/13 of 2023. So when will we see Dow 100,000? I mean, just go back to that previous slide. We first crossed through 10,000 in 1999. And the Dow's up, call it 3.7 times since then. And let's just say that's 25 years. Close enough. Well, if we were to do that same math over the next 25 years, we will definitely be over Dow 100,000. When I ask this question to folks, especially in large gatherings, I get all kinds of different answers, but most common 20, 30 years, 50 years. Those are very common answers when I ask that question to people. Going back to November of 1972 through the end of October of 2023, the Dow has achieved a 7.2% annualized return on a price only basis. So that doesn't factor in reinvesting dividends or anything else. Dow pays dividends just like the S&P does in my previous example. If you factor in the dividends reinvested, which as people are saving, that's common, you reinvest the dividends, the annualized return increases to 10.7%. So when will we see Dow 100,000? At the 7.2% price return, the Dow will be at 100,000 in 14, just over 14 years. And if the return was higher, there's periods there where I showed the return was much higher for, that period of time. If the return's over 10%, the Dow will be at 100,000 in just under 10 years. Interesting when you think about it. It's the power of compounding and the power of the financial markets. For those that want to check my math, here's our pager calculator. And to see how it's all put together there. So where do we go from here? Our outlook for 2024. Well, I shared my price targets, and the reason I believe that those price targets are that's a wide range. I'm talking about less than 1% return all the way up to 28% return throughout the year. And most likely it's somewhere in the middle. That's basically what happened last year, kind of right in the middle. And because what we're seeing is, one, the economy is continuing to do well. The trend is still positive. We're not seeing a peak to the economy and starting to see a rollover. Inflation is continuing to ease. It's steadily coming down. You can see going back to the summer of 2022, inflation spiked and now it's been coming down. Interest rates are expected to come down next year. The market is expecting some fairly decent rate cuts. The Federal Reserve, they're indicating that they don't think it's going to be nearly as much. Now, this is their expectations as of today. Federal Reserve thinks by the end of next year, 4.6%, where the market kind of thinks it's closer to 3.6%. Again, we'll keep a close eye on this. And consumers, wow, they're doing well. Consumer sentiment, though, is still negative. I've shown this graph before. And the reason I show this is because when consumer sentiment is negative, that's a contrarian indicator. When consumer sentiment is very strong, that doesn't necessarily mean that stocks are going to go down, but it just means forward returns could be a little less than the average. We're still very low. This graph, what this looks at is troughs in consumer sentiment, where we've had peaks, then it's come down. And forward returns after they've gone through a trough are very strong, and we're still very low. Consumers, though, aren't feeling like things are well. Again, a contrarian indicator that we pay close attention to. And then the number of new high, when stocks hit a new high. So the Dow, Dow just crossed through an all-time high. And that's happened 11 years in a row now. Might not realize it because we've had 2 years where it basically went sideways, but the peak was early January of 2022, and then we just crossed through a peak again. And then there's periods where it takes a little bit to hit all-time highs. But stocks hitting all-time highs after kind of periods where there hasn't been an all-time high has historically been a very bullish development, meaning positive for stocks. So what this looks at is, again, the Dow, since that just hit an all-time high, is the year following an all-time high after it's been more than a year without reaching an all-time high. So again, we just did that. It's been, yes, there's been an all-time high every year, but it's been more than 12 months since the last all-time high because it was in January of 2022. So we're close to 2 years without an all-time high. The average return over that period, 14%. The median return, 16% over the next 12 months. And it's been positive 10 out of 12 times. And I on board with this. This falls in right in the middle of our market multiple projection, kind of based on what's happening with earnings, with interest rates, where the jobs market's at. Definitely a very real scenario for stocks to have another good year in 2024. And we're getting close to the end of December. Still, a couple weeks left. And there's a phenomenon that's called the Santa Claus rally. And typically, that kind of people look at that and say, well, when does it start? Well, it usually starts kind of middle of the month and has a strong finish to the year. You can see this is going back to 1950 and looking at returns in December, and see the last 2 weeks of the year, basically from December 15th on, have been fairly strong. Well, you could even take it and say since Taylor Swift's birthday on December 13th, markets tend to do very good. So I don't know. Here in Kansas City, maybe we'll call that the Taylor Swift indicator, replacing the Santa Claus rally. So thought that was kind of interesting. December 13th through the end of the year. Historically, that's done very well. So let's look at 2024. So, what we're looking at is a lot of different data points, but basically confirming that the Fed is doing a good job of creating a soft landing, meaning they're slowing the economy down enough by increasing interest rates, not being too aggressive. The fear was that they were way too aggressive in 2022, and the markets reacted to that. Now, markets realizing that, no, they didn't just create a massive recession, and markets reacting positively. I think that continues in 2024. Inflation is stabilizing, so less of an issue, meaning that interest rates can start to come down a little bit, which that is the expectation from the Fed in 2024, both from what they say and from what the market expects. And, I think it's important to, as I finish here, to just take a step back, kind of celebrate the year, no matter what happened. I mean, look at it from an investment standpoint. Yes, it was but it's also a good time to just celebrate in general. It was a challenging last couple years, definitely from an investment standpoint, and markets are getting back to all-time highs now. And when that happens, that historically has led to continued highs in the future. And I think there's going to be a lot of opportunities from an investment standpoint for us in 2024. Well, I appreciate all of you joining our webinar today. I want to wish all of you a happy holiday season and a great new year. Looking forward to 2024. Also, check out all of our blogs, podcasts at keenwealthadvisors.com under our retirement resources page. And lastly, too, if you'd like a copy of Bill's book, Keen on Retirement, Engineering the Second Half of Your Life, it's on its second edition, Amazon bestseller. Happy to send that to you. Just send me an email at mwilson@keenwealthadvisors.com, or you can send it to anyone on our team. Just request a copy of the book, and whether it's for yourself or it's for a family member, colleague, let us know. We are happy to send that out. Again, thank you all for attending and wishing you a great holiday season.